Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Welcome to the Foundation for the Study of Cycles. My name is Lars Fontin. We are live again once a week, Monday, Cycles TV. Let's do some live analysis on cycles. What's on the agenda today? I promised in my last session that we will need to analyze the stock markets differently. We cannot just analyze one index globally and then assume that these cycles will more or less follow all over the sectors. Therefore, let's start with the US tech sector, which is currently in current attention of the market participants, to say it in a neutral way, and to see what cycles can tell us from the situation without commenting on the current. Is it a bubble? Is it not a bubble? Is it artificial intelligence? What is the current valuation of the tech sector? That's something market analysts will do. We are analyzing the dynamic time cycles based on digital signal processing. Nothing more, nothing less. So that's the purpose I want to review with you. I've prepared 3 charts. The first is let's visit the NASDAQ 100 index daily. Let's see what the cycles tell us on this chart. Second, I always recommend to have a look at kind of sentiment data, and therefore we could use the volatility index on the NASDAQ 100, which is also available. So this time I will use the volatility index to analyze daily fear cycles, volatility cycles in the tech sector. Let's see how the daily cycle analysis and the cycles in this volatility index maybe tell a story or do not tell a story. And then the third analysis for today is about, let's review the ratio or the spread between the broad market and the specific tech sector, because this spread is in a special situation these days. We know about the situation. And if we analyze the spread data set, also in terms of data, we can see if cycles give us any clue. I mean, this is new territory. There's no historical proven data available, but let's do this as the third example. Tech sector, focus, 20 minutes, 3 charts, 3 analysis. Right, so we are live. I would be happy if you just put your questions aside in the chat. I will have a look at them during the session, latest at the end. You know about it. I will take some time to visit your questions again. So let's get started with the NASDAQ 100. The index, it's the futures here, but at least it's the same data. So this is the NASDAQ 100 futures, which is trading at that level. So this is where we are today in this data set. And if we want to have a little bit more data, so in this case, you know about, I have added a little bit a longer historical analysis. You know that just using the current analysis is out of sync, so the price is out of sync with current analysis of cycles. I will not repeat this analysis. So therefore, let's add some more data to see, even if we do some more averaging about historical data, if there is any indication about active cycles. That's just the only reason, but not adding too much data here. So just going back to the year of 2015, 2,000 data points, so double what I would use normally, but this includes also the swing here we had in the year of 2000, besides this long-term upturn trend. Yeah, so let's put this data set into our analyzer with the latest upswing here, and what I like from this analysis, and you can play with the start and end points on your own, is if you have a look at the spectrum here at the bottom, and there's a clear indication about 2 peaks which show up in the spectrum, I think without any need to discuss here. So what we do with the spectrum, just to give you a quick primer, if you're new to this channel here, we're looking for the peaks in the spectrum which have the most dominant peak, which means they are sharp. So the left and right side of this peak is a very sharp peak. The amplitude is high on this axis here, and the separation to the left and to the right is good, so that there are no peaks to the left and to the right the same height or amount. So this peak is clearly outstanding, nothing to the left, nothing to the right, good separation in the spectrum. We have a Reen triangle, which means the strength score or the size of the triangle is large. The green color indicates a good Bartle score. So if I hover over it, it's about 180 days. And we know from different analysis in the global US markets that the cycle with a length of 180 days plays an important role even in the past years. So we know from historical analysis, we know from this simple view of the spectrum, this should be an important cycle here. If you look into the table view here on the right hand side, you see that this cycle here, the Bartle score, is one of the highest Bartle score. By the way, it has picked automatically by our new artificial intelligence cycle peak finder, which means that it automatically uses what I tried to explain with the visual shape in the spectrum. So it does a visual detection, not only from simple data points, also interpreting the visual shape and then taking into account different rating categories to pick from, and then at the end coming up with a score. So this is not only, this would be simple, it's automatically picked by our new algorithm, so you even don't need to understand how to read a spectrum. And then if we look at the second peak in the spectrum, it's obvious, it's this one here with a length of 330 trading days. What we are seeing here, so this is also a second peak. Nothing to the left, nothing to the right. The right shoulder is not as perfect as I would like it to see, but it has a good Bartle score. We will find it here also on the table. That's the cycle here. A good Bartle score, good strength score, automatically selected as second cycle. So it's kind of obvious which 2 cycles to pick here. We will activate them now as an overlay on the chart. This is the 180 days cycle, and this is the 330-day cycle now as a composite overlay to the chart. And we can now even zoom in or clean up the screen a little bit and just cross-check in the past how tops and bottoms of this composite have fit to past tops and bottoms in the markets. So that's obvious, but these 2 cycles seem to play an important role. What it shows us now for today is, and that's always what almost no one is able to explain, why we still see this push upwards here. So this is the so-called AI hype, we've seen in the markets from here, where the dominant or the composite cycle model based on these 2 dominant cycles has already turned down since April. Since February, April. You know that I highlighted that this cycle should come to a top in March. So I showed you this kind of cycle model often in this channel here, which showed us a peak around March this year, which is more or less exactly this cycle here. If you analyze the NASDAQ by itself, it shifted a little bit to the right, but it's still in the downswing. However, the hype is still pushing the index up. So this is the point where we have the deviation price still moving up, cycle still showing that we are in a downward swing until, and that's always what you're looking for, until late summer. And therefore I don't have any real news here for you. This is what the cycles model on the main indices always predicted. So there's still no real change in regard to the cyclic model. The only message, or what we need to observe here from the daily cycles, is that since March, from March to April, May, now beginning of June, we see a deviation between what the cycles predict and what market price action is doing. That's always something around the corner. I mean, either the cycles model is wrong or the price. That's nobody knows right now in the markets. That's the holy grail. We will see if the price now turns into direction of the cycles, or the cycles are just wrong. So that's where we need more confirmation. And to get more confirmation, for sure, we need to open other cycle data sets, or at least other data sets, apply our cycle analysis to see if they speak the same message. By the way, what you see here is the new version, which will come live next week. So if you are on the wait list, you will shortly receive an invite from the Cycles Foundation for a special meeting next week. Yeah, and you will get access to the updated cycle analyzer now from next week on, and I'm now using this one already here. And just to show you one feature, is the from my last session here, that the cyclic RSI, you can use this information to fine-tune technical indicators. And to make this even more easy, I have integrated this feature directly into the scanner. So just with a click of a button here, you get one very important technical indicator, which is adjusted to the cyclic data, and using this information. And this is nothing new. So we have the confirmation here since, let's zoom in here. Yeah, since March, end of March, this indicator is overbought. So that's why we are still in the same situation, and there's no change in this analysis. So that since March, we are now in this overbought, yeah, a situation here. So the signal line crossed above the upper bands, still moving higher, but we now need to wait. The confirmation is in once the signal line crosses below this upper band here. So, but it's not often that this time takes this amount of time here. So it's really stretched time-wise, also from the indicator. And this is also what we see from the cycle here. So technical condition, cyclic condition, still pointing downwards. Nobody knows if this is a bubble or not, but at least that's the cycle analysis on the daily NASDAQ. But we have more data to analyze. Therefore, let's now switch to a second data set, which I wanted to share with you. Let me open it. And it's let's have a look at and I always use this kind of information, the volatility index. I like this also on the S&P. I often use the VIX index for cycle analysis. But as I mentioned last time, I think from now on, cycle analysis will get more complicated in these markets, these times. So we need to analyze specific sectors and also specific volatility index data set. And this is now the volatility index on the NASDAQ 100. It's more or less available. So we get a more specific volatility related to the NASDAQ and not the broader markets. So this is where we are today. You now see also that the spectrum analysis is not as easy as it has been in the price data set. So here you see lots of ups and downs. Here and it's a good learning, good example here. So our automatic algorithm has just detected two very short cycles here with a length of 40 and 51. You can see them here on the left in the spectrum. So these peaks have been picked by the AI algorithm, and you can also now see why, because the sharpness of these peaks here in the spectrum is very obvious. So this one stands out if you compare it to the left, to the right. It's a very sharp peak, good strength, high Bartel score, same here. So these are very strong short-term peaks. But so you could pick them if you are really after this short time analysis, and just for fun, let's do this. But I think this is For my style of analyzing cycle, that's too short. I mean, a cycle with a length of 40 to 50 days is repeating every 25 days. So you have 10 to 20 days. And as cycles are not that exact on the day, you always have the deviation to the left and the right. So after the fact, it might be interesting to analyze such short-term cycles, but I would never recommend to use such short-term cycles on the daily chart. I mean, you could 40, 50 week cycles, if you're in weekly cycles, if you then trading on the daily time frame. But if we are analyzing daily, and it's also interesting to derive your decisions on a daily time frame, 40 to 50 cycles is a very, very short cycle length. So therefore, this is nothing I would be interested in here in the left hand of the spectrum. And then just if we add our knowledge what to pick, it's obvious it's this one here at around 172. I think it's clear. And you can tweak the AI algorithm with if you give him some parameters to exclude shorter term cycles. Yeah, but that's then more for a special indication or session on these features. So 172 seems to be an interesting cycle in the volatility. And maybe you remember in the price data series, we had around 180 days. Yeah, so this is always interesting if you see this similar nominal cycle. Yeah, so a cycle with a length of 180 days in the price data set, now 170 days in the volatility data set. Looks like we have the same nominal cycle, just slightly different due to the principle of variation. So 172 looks quite nice. And here we're kind of observing the similar shift or out of sync relation between price and market data, because just a quick cross check of this cycle here on the chart. Yeah, let's do this here together. You see now the overlay of price and the cycle is very nicely in sync here with past major tops and bottoms. And you know that we are not looking at the absolute price or volatility index level. We are interested in the timing of these cycles now. So this timing of a top was quite on, and we ignore the absolute price swings here. So this was the low timing wise. This was the high, low. Here, that's the high assigned to this top. Here, the timing low. This was clearly off here, this period. But then the low, the top here, the low here, the top some. So now we should have seen a low here in March. And the cycle is off. So we are in an upswing cycle since March until July, while the volatility index still continues to move down. So that's the same deviation we've seen in price. And you know that volatility cycles need to be read vice versa. So a low in the volatility index refers to a major price top. Yeah. So in March, we have expected markets to top, which obviously did not happen. So we are now continuing in the July period, where then an low is expected, and then the cycle swings. So here we see the same deviation, but now let's add also the second cycle, which we've seen here, which if we want, I mean, this is not really a perfect fit here. And the reason why this is not one of the best cycles to pick from a spectrum is because the amplitude, the amplitude here on this axis is not the highest. If you see it to here, and it's more like a plateau, so it's not a quite sharp peak in the spectrum, and how the ideal cycle would go more down to the left and the right. So, but in reality, nothing is perfect. Also, not a cycle's spectrum. We need to deal with that fact. We don't know where this longer-term cycle seems to top here, but therefore we should switch to a weekly chart. So the second one, which we could use, is this one here. I would not use these two peaks here, as this is a double peak, and you really don't know which is the right one. They are too close together, and there's no real, if you observe this, there's no real downswing in the spectrum between these two peaks here, so that's really bad. So the only possible option is this 303 days cycle in the volatility index, and I can click them on and off just to show you what the difference would be. And you see it's not really a difference. I mean, it's a difference if you look into the past of this cycle, but if you look into the current timing of this composite cycle model, and we are only interested in the current past and the current future. Yeah, that's the only time horizon we are looking for time cycle projection. If I switch it on, you see it's the low here, it's the top here, and if I switch it off, it does not really change in a very dominant fashion. Yeah, so it's more or less consistent. If we switch to these two cycles here, just a quick scan here over the full time. Looks like these two cycles very well explain the volatility behavior or the fear index, the volatility index. Yeah, and we are in this upswing cycle of this volatility index, which correlates to a possible downswing in price action. So same conclusion as we had on the price cycles model, right? So same outcome, which is, if you do cycle analysis, which is good. If you have two cyclic models, slightly different cycles, different data sets, but give you the same conclusion how to read the outcome. I mean, it's still in alignment with our cycle analysis on the data set we did. So a downswing into late summer, still confirmed by cycles. What I can show you here is just as a preview also, you know that next week we're launching the new version. There is an integrated charting feature in it now. So a request which often came up was, can we save this composite and overlay it now on the price data? Because we are analyzing volatility cycles, build a composite model of volatility index, but we want to see this cyclic model now on the NASDAQ 100 price series. Can we do this? And yes, you can do this now in the future. Therefore, let me show you how to do it. So let's assume you have created your cycle model like I did here. So then the important step is we can now save a composite. Yeah. So this composite we have created here, just one click, we will save this model now, which means we can reuse this composite model on different other instances. And now I will show you to create a chart to do more complex analysis. So therefore, first, let's open the NASDAQ futures dataset. So just the same data we had in the cycle scanner. Here we have it. So now what I wanted to show you is, besides all the basic technical analysis, we can now overlay our composite analysis we did. Yeah, we just click compare to open another data set. We want to allow to extend into the future. And we just need to understand how it's labeled. And the composite data set starts with CC. Yeah? And we see here now that this is now showing up as composite volatility index data set. This is exactly the one we saved. Yeah? So we just click on it. And what we see here is now the overlay of the cycle model from the volatility index now on our price series. Maybe that's not readable what we see here. So we can arrange this. We can move this into a new pane below. So now we have our composite plotted as an indicator. And as I explained, volatility cycles are exactly the other way around. So low in volatility cycles are tops and market highs. So we can now change the scale. We just invert the scale, so the cycle is now flipped. And now what you see here on the chart is the NASDAQ index and our cyclic model we derived from the volatility index. Yeah, and you can now see that here we have the top in the volatility cycles, which is this top here, the top in the volatility cycles, which is this top here, the low in the volatility cycles, which is here around, here, interim top, and then again, this is what I told you, the major low in volatility inverted shown now on the price is the top in March. And we are still in this downswing here with more room to go into August this year. before at least the volatility cycle. And I could now also pull up the dominant cycle we built on the NASDAQ itself, add another pane as an indicator. So then you have 2 cyclic models below the price series. And you've seen now, I just did it live, how easy it is in the end to flip between cycle analyzer, saving composites, switch to a chart view, add your composite, invert your cycle model, whatever you want to do. You are more or less flexible, whatever you're interested to do here. Okay, now what's the takeaway? The takeaway is that we have analyzed the specific tech sector here. We've seen on the daily dominant cycles model that cycles still, and even with latest data, we have latest data in, which is moving up since March. The cycles still are based on the old cycles model. So cycles, even though new data has been thrown into the analysis, have not switched. There's no cycle now showing us an upswing. Still the cycles model in the early stage of the downswing, and there's room to go into late summer from the daily cycles we have here. And this is confirmed looking at volatility cycles, at least at the tech sector. So this current rally in the AI hype needs to be taken with care, looking at dynamic time cycles. That's the takeaway. And just for fun, to add now at the end an interesting data set. I don't know if cycle analysis really is useful in that, but just to show it to you here is when we are analyzing the spread. So, and let me show you the data set first. So I'm talking about the ratio, and it's shown here in the upper left corner, the ratio between NASDAQ 100 priced in Dow Jones index. So the spread between NASDAQ divided by the Dow Jones. And you see now when we had these extreme situations, this is, here, what you see here in the past, this is a weekly series. This is the internet bubble. When we had the past huge outperformance of the NASDAQ compared to the broader stock market, and a similar situation now, or a similar absolute level, we reached here at the end of 2021, which gave us the downswing in 2022. And you see now here how quick we rallied again to these absolute levels here. Which you see here, which is quite similar to the internet bubble. At the top we saw end of 2021. At least the spread is now at a similar level. Maybe you have seen these kind of charts from other market analysis colleagues already, but we can throw in our dynamic time cycle analysis to this kind of analysis. So let's do this now together. I will switch now. I've loaded this data into our cycle analyzer. Where is it? It's here. That's the ratio. That's the spread here. And by the way, this is what you can do with the cycle analyzer. Once you have prepared a kind of composite data set or spread data set like I did with the charting application I have used, you can export this data set and you can just import this data set manually if you have this kind of special data set. That's the same what I did here. I just did an export from my charting application and did an import here in my private data sets. So, and by doing that, and as I'm interested in a general swing analysis in the cycle, I'm not really interested in forecasting because you can't trade this spread anyhow. But to see if we use a little bit more data in this data set, that's why I said, so 2018, so 5 years of daily data. The spread, that's, to be honest, not too much historical data. So this latest upturn into 2021, and here's this latest swing here. And if you have a look at the spectrum, I think this is now more or less a simple spectrum to read. We have one clear peak in this chart here. So there's no discussion about what to peak here from the spectrum. Nothing to the left, nothing to the right. So it's about what is this? 208 trading days. So let's activate this cycle. Yeah, I mean, you can read on your own where we are in this cycle here. So it means that, and we need to be careful, as this is not the price of the NASDAQ, and it's also not the price of the broader market here. This is a spread indication. So it looks like that, and let's plot this as a zigzag here. So this is top here, here, low here, here, top here, here, and low here. Here, so this is how you quickly synchronize if this cycle from a kind of swing. Yeah, this is what the dynamic time cycles help us. They help us to identify the timing of the swings. This indicates that we are currently at that point in time, which would mean that it would resolve to the other situations. So, and there are now two possible scenarios which could make this happen. So either the tech price will move down by a large amount while the broader market still stays flat, or you can see the broader market now follow these upswing while the tech price will more or less go sideways, or a combination of both. So this is not too easy to see, but it looks like from this kind of spread analysis, we have reached an extreme situation, and the time cycles suggest that this extreme situation should be reversed, at least from the spread. As I said, this is a very new way of analyzing cycles, so there's not enough historical evidence that we can use this information. But I think as we are exploring different ways to apply cycle analysis, I think this is a very interesting idea, and not just analyzing the raw price information, also analyzing this kind of spread, and if from a time-based point it's expected to change now. And this is giving additional confirmation that a possible downswing in the tech price could or should now happen. And if you see the timing of this cycle here, it's also the downswing, at least of the spread, into late summer. Complete different cycle with 200 days. This is now really, from a spread perspective, not an absolute price. It's the behavior of two different price data series in relation to each other, and seeing if there's a cycle between these asset classes. So it's really complete different kind of analysis we are doing here. So the cycles, we could come to a conclusion here, could show us a complete different picture. But now this cycle, and that's maybe new in this kind of analysis, this cycle is just turning now. So I cannot explain you or tell you that this was the reason for the rally since from March to June, because this cycle still had some room to go to the upside from March to June, and I didn't have this on my list of analysis. But at least now we reached also in this cycle now the topping point here, which means that the spread or the relationship between these two data sets should now reverse in regards to this extreme behavior. Okay, so that's the third analysis I wanted to show you, and I think the conclusion is still the same. And I don't know what markets are doing outside here, but we are doing cycle analysis. So please do your own conclusions. Learn a little bit how the cycle analysis works. Oftentimes are not as easy out there. It's just a simple analysis, so it's more complex what's going on there. You need to take into account your additional analysis routines, technical analysis, price analysis, that you get your own conclusion out of this kind of cycle analysis. Now, let's spend some time visiting your questions. So therefore, just give me a moment to browse through the list of your questions. Okay, Dan, and I think this one here was relating to the NASDAQ 100 analysis. If the spectrum of the NASDAQ would not indicate 181, and would you pick 86 or 89-day cycle for both or none of both? So good question. Let's get back to that chart here. I think give me a second, I need to grab the right one here. I think it's exactly this chart here, and I will disable the selected cycles. So we had chosen the larger ones, and your question is related, I think, yeah, exactly to these two ones here. So, and the answer is yes. So let's assume these two peaks are not there. That's I think your question. If we don't see these two peaks here in the spectrum, what would be the next peaks in the spectrum? And therefore, let's just zoom in here to bring it to your attention. So this would be out. So the next peaks from an amplitude, yeah? No, so let's see here the level. These two peaks stand out of the spectrum. Okay, now I understand your question. We need to be careful here. So this is the 86 and the 89. So they are more or less too close together, but at least you're right. This is the next peak in the spectrum we see here. The way now to decide which one to pick from these two or none to pick is the following. So let's spend some time on that here. Let's zoom out again here to see the full picture. I would now switch between both and see if we get a different outcome timing-wise of these cycles. If we get a complete different projection timing-wise, then I would use none of them. If we get more or less the same timing confirmation, then I think you could just pick one of them, because it would not matter, because the timing projection would be the same, and 86 or 89 would then anyhow not matter. So let's check that. So let's first use the one with the length of 86. Let's activate it. And as said, I'm not interested in the full historical view, so therefore I'm just zooming more into the current projection here. So that's currently projecting a low and then the upswing cycle into August. And now let's switch to the 89 cycle. So first let's deactivate the 86. Let's use the 89 cycle. Therefore, we need a little bit too careful with this jumping around. So this one is a low in June, top in August. I think it's slightly shifted to the right, but it's not a big deviation. And we can see this if we add them up both, should look close, similar to one cycle. And yeah, exactly this is what happens. So and that's what I wanted to see. If I'm now building a composite of these two cycles, you see it just looks like one cycle. Yeah, there is no big difference. So they have the same phase, meaning that they are slightly different in regards to their length. But if you just check the phase of these cycles, they are absolutely in the same phase. The phase gives us an indication where we are in regards to the top or low at the current point in time in that cycle. And it's the same. So it would not matter if you pick 86 or 89 from a projection perspective. I mean, if you're interested in a perfect historical analysis, for sure it would matter. But if you are mostly interested in the projection horizon from now into the just near future, you're not looking for the next 1 or 2 years, just the next turning point. And as said, just the next turning point, which currently low in June, so this month, and a high going into August. This projection is the same, and it doesn't matter if it's the 86 or 89. So Dandy, that's the answer to this question, and even the procedure, what you should do to decide 86, 89 or none. If we would have received complete different phases, so one projecting a top in August and the other one a bottom in August, skip it, don't use it, it's too close together, different outcome. That's the answer. Yeah, Christoph, that's, I think, the holy grail question. I think that's now for the experts on market environment. That's maybe not commenting here based on cycle analysis, but that's why we need what we would get to know could then explain the deviation between price and cycles. I think a lot of people do not understand what's happening out there, and even cycles cannot explain it, at least not dynamic time cycles. Okay. Eric, Looking at the weekly cycles for the NASDAQ using the cycles peak of 179 weeks, the rising NQ value. Okay, so that's I agree. What we have not done here is you should also analyze the context of longer term cycles, which in this case of daily cycles would be the weekly time series. But thanks for bringing this to our attention. If we have a current gap or disjunct between weekly cycles, again still pointing up, and daily cycles now pointing down, then we have the conflict in long and short-term cycles model. We don't have this on the S&P, which is also projecting a huge bottom in late summer this year. But I commented on that in my last live session where we had this market talk, or this jam session where it gets hard when you have conflicting cycles models. Yeah, I think, to be honest, not today, but looking at the treasury note and cycles in that kind of data sets would also be interesting to understand more or less the generic market conditions we have in that area. Not only 2 year, I think 10-year, 2 year, 1 year, maybe 3 months would be interesting to see how they correlate to cycles. So I will take this down as an idea for one of the next Cycles TV live sessions, Christoph. Because it will take some more time. It's not just a quick look, but it's a very good idea. And I promise next live session, we will analyze treasuries and bonds. Yeah, maybe, Mike, that's also a very good and question often raised. Why do you prefer trading days instead of calendar days? We are analyzing time data. Time is continuous. Yes, so thanks for this statement. Time does not stop on weekends, right? So, and I like your statement. And yes, often maybe we should analyze calendar days. By the way, you can quickly change this analysis in the cycle analyzer to do that. But the question, why do you prefer? The main reason is, in my experience, there is no big difference, to be honest, if you use trading or calendar days. If there are this gap of these 2 days, it will be taken into account by the signal processing algorithm. So the length of the cycles will be shorter just using trading days. And if you analyze calendar days, it just will become longer. So you will detect different cycle length if you use trading days or calendar days. But the projection outcome, so when is the next top or bottom on the calendar time-wise, then does not really matter if we have used trading days or calendar days analysis. So the outcome with the projection, which we are interested in, it's the most important one, is more or less very similar. And then to make it just easier, I'm just using trading days, because the outcome using calendar days will not be, in most cases, really different. That's my answer. So that's why I prefer it. The outcome is not different. For sure, the detected cycle length and phases are different. So you cannot argue if you apply other frameworks. So if you have first cycles in mind or other cyclic models, you always need to be aware that if they work on the continuous time axis, you should not use trading days. Because then you also need to recalculate from calendar days to trading days, and this offset calculation is different. But if you're just analyzing it's not as simple dynamic time cycles, the near future projection using trading or calendar days in most cases will be the same. Brackets, but cycle lengths, phases are different. So that's my short answer to that. In general, you're right. So if you want to do a more complex analysis, use calendar days. If you want to bring another framework, be careful that you use the right setting here. So how could you change this? For sure, you could go to the settings. You could go to pre-processing, and there you could fill missing data. So you can go to calendar days, which in that case will fill the missing days, so on the weekends, so you have a continuous time axis. So this is now the NASDAQ on the calendar days, and this is what you see here. So the length of this cycle for sure changes. Yeah. So for sure you see a complete different length in cycles, but you see it's from the spectrum, the same clear reading, and from the analysis, it's the same outcome. Yeah, a low here in late summer, and we are on the downswing. So yes, we see a different cycle, but the projection outcome is the same. So I hope I showed here that you can switch both approaches here in the cycle analyzer, and hopefully I showed you why I often use training days, as the outcome is more or less what I'm interested in, more or less the same. For sure, it's the different setting you have to be aware of. Okay. I think William. Yeah, I think you did some interesting discussion in the chat. I cannot follow up on each topic, but it sounds like good discussion you had here. I think I hope I showed you that. Yes, I showed you. It has. You can switch between both. Okay, and then you can bring in additional models from Hurst. In other sessions I introduced, you can use the concept of future line of demarcation, which is an offset based on the dynamic cycle. So, that's different. We don't use static cycles in FLDs. We use the dynamic time cycles, FLDs, which is more on the current cycles, but that's then at least using principles of Hurst here. Yeah, then I think that's, as I commented, I think for sure you need to set this into context of the NDX Dow Jones weekly cycle analysis. I did in daily here, that's right, to see the context 2000-2008. But I outlined now the concept. I think you should be able to do this, and I think that's a good follow-up now for this evening, tonight, or your own studies, as I want to spin your ideas here in that session. Intraday analysis, we will take this into account into a special session, and with the latest update there are more options to stream real-time data into the cycle analyzer, so I think wait one additional week, then we have it in the analyzer. Maybe William, how many other data sets can you stack on each other with a new update? There is no limit, to be honest, William. I think the visual size of the screen, or different panes or overlays on the chart, so you're more limited what you visually can really interpret. There's no limit in how many composites you can add to the chart. So like the example I showed you, there's no limit. So you just need to save the composite from your cycle analysis and then pull it up in the chart, and you can stack this up with, I don't know how many you want. I use 2 or 3 models, not more than that, because at least from my visual interpretation, I'm able to grab that. Maybe you refer to the analysis I did here for US natural gas and the current oversold. The cycle is still valid. Yeah, so we're still in this long and short-term downward building phase, and an expected longer upswing to come from here. I mean, this data series, futures, commodities have a high volatility. We know about it. Monthly cycles, that's a good idea. Maybe I should dedicate an update session on natural gas. I just didn't do it because this cycle is still valid. That's my short answer. Smiles are good here for you. That's it for today. So running more or less for an hour here. So I hope you enjoyed the time looking at the tech cycles, discussing some new ideas. different data series, putting some cycle analysis to work, introducing some new features in the cycles application, and have our live discussion. So I enjoyed it. Hope you will join next week, Monday, same time, same place. So no travel is planned. So at least for now, I'm planning to do it live here next week, next Monday. Throw in your comments, ideas in the discussion. I will look it up and then get some ideas for our next session. Thanks for joining me today. Have a safe week. Stay safe. Enjoy some.